Okay, now cost of goods sold. This is a kind of a confusing area for a lot of people. I notice even for bookkeepers that the things that go on cost of goods sold just kind of never fail to surprise me. Here's our form for cost of goods sold, and let's just go through the math here real quickly. So what you see on line 33 is that they're asking us, first off, how are we valuing closing inventory? Almost always it's going to be cost. There are really very few micro businesses that are going to deal with lower of cost or market. It's an option, but I have not seen micro businesses doing this. Are there any changes? Hopefully not, because if you change an inventory method, you need to get the IRS's approval first. Inventory at the beginning of the year, purchases, less cost of items withdrawn for personal use. So this is just where you put your purchases. Cost of labor, this is direct labor. Okay, this isn't labor that you have paid to yourself. This is labor that you paid to someone else. Materials and supplies, other costs, we add them all together, and then we subtract the inventory at the end of the year, and this is cost of goods sold. So let me run through an example with you, and hopefully that's going to make this a little clearer. Okay, so let's say that our client manufactures gizmos. Okay, gizmos is not that original, but I couldn't come up with something else. Gizmo consists of one gadget and one widget. One gadget plus one widget equals one gizmo. At the end of the previous year, the client had inventory of 150 gadgets and 240 widgets. Now, he has to value these. Gadgets were $20 each, widgets were $10 each. So here's his starting inventory, valued at cost. Okay, here's the math. $5,400 was the starting inventory. All right, during the calendar year, our client purchased $75,000 in gadgets and widgets. Now, mind you, COGS is not tracking gadgets and widgets separately. The COGS is adding all this together. Now, in his inventory that he's giving you, hopefully he's got these things listed separately, right? Okay, now, in addition, he paid labor costs of $50,000 for the work involved in turning gadgets and widgets into gizmos. This is not his money. This is money he paid to somebody else. Now, what else? He paid $500 for shipping boxes and $1,000 in shipping costs for the gizmos that he sold. So our software, and thanks for that software plug, Jeff, our software takes the starting inventory of $5,400 and adds in the purchases of the labor cost, the boxes, and the shipping for $131,900. Now then, what is our closing inventory? Our closing inventory is 550 gizmos and 850 widgets. The value at cost, see, we did not change our method of valuing inventory, is $19,500. We take that $131,900, which was cost of goods sold plus starting inventory, we subtract the closing inventory. This is the cost of goods sold. Now, why was there so much more ending inventory than starting inventory? And here's the answer. A lot of our clients are going to make this management decision right around December 2nd that the best way to pay less tax is to buy more stuff before the end of the year. Okay, so the problem is that he doesn't really get to take that deduction because it's going to be sitting there in his ending inventory and it gets subtracted out. So it's really an important point to make to our micro business clients that if you need to get rid of some income, and I'm putting that in air quotes, you can't see it, but I got air quotes going here. If he needs to get rid of some of that ending, that income, he really should not be investing in inventory. That's not the best investment. If he needs to buy a piece of equipment, needs it, that's a better thing to buy. But stocking up on inventory is really not the best plan for paying less tax. There can be a non-tax reason, by the way, to buy product. The stuff's on sale or the company's going out of business, something like that. But it's always a good idea to have your client understand what cost of goods sold is so that they understand why it's a bad plan to load up on inventory just before the end of the year. Okay, let's talk about inventory methods. Now, for most of our micro business clients, inventory methods aren't a big issue. They don't keep a lot of inventory around because they don't have the space for it. They don't have the money for it. There's not a lot of inventory around. So what do? They count what's on the shelves. They multiply the result by what the item cost, and we're done. But it can get more complex than that. When prices of products change, the way that the inventory is valued can make a big difference in the tax. So the two inventory methods that the IRS likes the best are called LIFO and FIFO. So LIFO, last in, first out. What this means is that the last unit that hit the stockroom is the first one that's going to be sold. When prices are going up, the items that are being sold will be the ones that cost the most. So there's less taxable income. Now, FIFO, first in, first out, means the first unit that hit the stockroom, the one way in the back corner there, is the first one that's going to be sold. When prices are going up, the items sold will be the ones that cost the least, and there's more taxable income. So, this kind of can be, this is a decision that does impact the tax. At the end of the day, hopefully it's all going to be sold, so it does kind of come out in the wash. But if your clients had a really good year, that might be, this might be a decision you want to make. Okay, let's talk about one other method, average cost method. This is not the IRS's favorite inventory method, but it is a legal option. The average price of all the goods in stock, regardless of the purchase date, is used to value the goods sold. Now, what this does do, the average product cost over a time period, kind of smooths out the cost of goods sold if there are going to be extreme cost swings in product purchases. So there are times when this is the right thing to do. Okay, there's also a specific identification method. This is a cost assigned to each individual unit of stock. This only works when the stock items are unique in some way, like individual pieces of art. My individual piece of art, I'm selling this specific piece, and it costs this specific amount. It doesn't work when we're selling bulk items and they all look the same. I don't think I've got anybody who's using the specific identification method. I think this is really unusual. Okay, so let's move ahead. So Part 4 of the Schedule C collects information from sole proprietors who are using their vehicles for business purposes and want to deduct mileage, which I'm going to say is probably most of our micro businesses. So here's what Part 4 looks like. So this is where we record the information for the client who is taking the standard mileage deduction. The lines for commuting and other, if all we're doing is taking business mileage, there's not a ton of point to that. It's helpful if we're also going to take percents of interest and other expenses. But if it's purely going to be standard mileage, then we really just need the business mileage on line 44A. The lines on 47A and B are more trick questions, more IRS trick questions, where the only right answers are yes and yes. And this is a good opportunity for you to discuss the importance of record keeping with your client. So if you haven't yet lived through an IRS audit for mileage, you just haven't lived. In seminar world, of course, the client has his or her logbooks ready to send into the IRS. And if there is a mileage record request from the IRS, your client drops off those logbooks, you send them off and off we go. I've lived through several mileage audits and that seminar world result has never happened. Half the time there really are no records, even though they've assured you very seriously that they do have written records. And I've even had situations where the client couldn't even recreate the log to match what they put on the tax return, which is kind of frightening. Now, if you ask for records for oil changes and tire rotations, which is another thing the IRS likes to see, of course, you'll hear that, gosh, that car is long gone and all those records are gone with it. And at that point, the audit's done, you've lost, and we have a problem. So remember, I always explain to my clients, if you're audited, the logbooks showing when, where, why, and how many miles, the IRS is going to ask for that. And the IRS is going to ask for records from oil changes and tire rotations that show odometer readings. Prepping your client for a mileage audit, particularly if they're claiming tens of thousands of miles on their tax returns, is really one of the best services you can render. And I really think that you can't scare them enough. And this sounds terrible, but I just think you just cannot scare them enough. Tell them how terrible mileage audits are. Tell them, about back taxes and penalties. This mileage thing it really is an issue. Okay, and these days, there's really no great reason for people to not be able to track their mileage. We have mileage tracking apps. My goodness, people don't even have to write stuff down anymore. We have Mile IQ, TripLog, Mileage. Every time I turn around, someone's got some kind of new app. that they found. Now, what we want to make sure they do is that they get a service that allows them to print reports, and tell them, print the reports periodically, at least monthly, so that we have records in case of an unforeseen phone disaster. And yeah, you know, the IRS will let us do some amount of annualizing. You know, hey, my client has 9 months of records and, you know, the cloud hiccuped on the last 3 months. They're going to let you annualize that. But I would say the IRS would probably not let you annualize 1 month into 12 months. This really has to be reasonable.